Hi everyone, and welcome to our penultimate webinar with Clive Lambert. Today we're going to look at market profile, which I know Clive is a big fan of. And then also, Clive, are you there?
Hello, Chris. Good morning or good afternoon. We're right on the cusp of both, aren't we?
I know. You well?
Yes, very good. Thank you.
Excellent. I was just about to say, obviously this is a penultimate webinar. For next week, we are still looking for topic suggestions. Is that correct?
Yes. Right. So next week is basically we plan to have a bit of an open forum, if you like, where I can discuss anything, any topics that people may have an interest in that hasn't been covered in the previous 9 webinars, or go over anything that was a bit unclear in the previous 9 webinars, or just try and bring everything together and talk about how you can combine everything. Probably best to do that by using real life markets as well, so it's nice and bang up to date and topical. So it will be a bit of a what do the markets look like now, and we'll go through the asset classes if we and any requests for methodologies and technical indicators or anything else to do with charts would be most welcome. Someone's already asked if we can look at Fibonacci extensions, so that's something I can throw together. And anything else, anything else people want to look at, please give myself or Chris a shout, or stick it on the questions box that's attached to the webinar software now. And yeah, that's what we're going to do. We're going to try and give you what you want, I suppose. Is that right, Chris? Give them
Yeah,
what they want.
fantastic. Yeah, like you say, let's look at methodology that people want to go over, or something
Yeah,
that
I
you
mean,
haven't
as I say,
covered,
right. So
or
right
or,
now,
e- or
got a
even
blank
particular
canvas.
market, so people can try to
Yep.
sort of put in place what you've taught them,
Yeah,
and see if it does sort of appear on any of the charts out there.
indeed. Yep. No
Right,
problem
over
at
to
all.
you. Market profile is not one of my areas of expertise.
Okay, well, I will give it a go.
All right, thanks, Clive.
Okay, nice one. Thanks, Chris. So yeah, we are in the afternoon now here in the UK, so good afternoon, everybody. Today I'm going to look at market profile and auction market theory, which is an entirely different way of looking at the markets, and it is a way of looking at the markets that has generally been just the domain of futures traders, particularly in Chicago and the US. But it is gaining in popularity. It's still at the stage where it's mainly on professional trading packages and not on the sort of the free stroke cheaper charting packages that most people are used to looking at. So that is a caveat to everything you're about to listen to. You might find it difficult to find it on the free charting you get from DF Markets and firms like that. But it is something that I use extensively in my analysis, and so those of you who have who took advantage of the extended free trial of my analysis, hopefully you've got a bit of an idea of some of the things I'm going to be talking about today. So I'm going to introduce market profile, talk about the principles of it. There's something called the liquidity data bank that was the starting point of it a few years back, and we'll go through that to sort of introduce the principles and the ideas behind it. Then we'll look at how a market profile is constructed, and then we'll look at longer term composite profiles, bell curves, auction market theories. Unlike previous or the last couple of weeks, I think I've got lots of slides to get through today, so I will do my best to go through that for you and to get through it in the hour. It's not like any other charting methodology. It organises the data very differently to bars, candles, point and figure. It still uses the principles of organising price and time, but it doesn't attempt to give any firm buy or sell signals. It builds up a picture of how the day is developing and then compares that to previous sessions. So what it gives the trader is an indication of market sentiment at any time during the day, whether the bulls or the bears are dominating, but more importantly, and something that's that it attempts to sort of add to the equation, if you like, is an idea of what type of trader is active, and we'll see that in the first few slides. The picture you see up on your screen there is the floor of the Chicago Board of Trade from about 20 years ago, and I've stuck that up, a nice colourful picture which shows that, because Peter Steidlmeyer, the guy who came up with Market Profile and developed it in the 80s, was a trader on the floor of the Chicago Board of Trade, now part of CME Group. And he was actually in the agricultural pits. He traded corn, wheat, and soybeans, basically. And I worked on the futures floor for 10 years, and when you look at it from that sort of bird's eye view that we've got on the picture there, or when you took somebody down there to show them around, quite often the thing that people would say is, "Crikey, George, look at this, it's just chaos. How do you know what's going on?" And actually, once you'd been down there a few years, you knew everything that was going on. You could stand on the edge of the pits, or even on the side of the pits, and you knew what was happening. You knew who was executing trades for who. I remember being on the futures floor, and there was one particular firm down there who had one of the best traders on the floor, best paid traders on the floor, and he spent a lot of his time doing nothing. But when he occasionally went into the Bund, the German government bond pit, he would do a massive order. It'd probably take him 2 or 3 hours to get one order done, and he would be busy, and he would execute the trades to perfection, never have a missed trade. He was, as I say, one of the best traders on the floor, and the firm he worked for was a little-known Nordic bank, basically, that had a very small floor team. The reason why I'm telling you this is because we found out, and we discovered that this little-known Nordic bank, their biggest client, their only client really, was George Soros. And so we knew every time he went into the trading pits that Soros was trading. So that's an example of it looked like chaos, but we knew exactly what was going on. Okay, we knew when Soros was trading. Back in the 90s. Not so transparent these days, and that's for good or for bad, I'm not sure. But Steidlmeyer got this as well. He got the idea that it was not chaos. There was a lot of order to this, and there was actually 4 particular types of client or trader or order types that were going into the markets. And so he worked with the Chicago Board of Trade to develop what was called the Liquidity Data Bank, which was a database of every single trade that went through the market at each price, and what percentage of each of the trades at each price were being executed by which particular type of client. And he had 4 client types that he split the market into, and they were called customer type indicators, CTIs. And so this is the very first incarnation of the market profile, if you like, and it basically split the market up into locals. Now, locals were and are the proprietary traders, the own account traders, the guys that were trading their own money on the futures floor. If we go back to our graphic there, you can't see so many actually in Chicago. The guys with the red jackets in the middle, these were all trading for their own accounts. I think there must have been some different colours going on in Chicago, but in London you could tell the locals very clearly because they had red jackets. CTI2 was what was known on the floor as paper, what's known to you and me as institutional money, real money. Hedge funds, institutions, central banks, the big 4 banks, pension funds, all the large paper orders, yeah, they were actually trading real, they were putting on big trades. CTI3 was other, which was actually where Steedlemeyer for this, and these aren't so important, but I'll go through them anyway. CTI3 other was mostly option traders. Sometimes you would get a large options order that would go through in the options pit next to the futures pit, and the local traders in the options would have to hedge their positions against the futures. So they would all put in very similar orders into the futures pit, and that would all happen over the course of like 5 minutes. They'd all be in the same direction, and they would maybe move the market for 5 minutes, but they were going to be finished soon, and then then the effect of that would go away. CTI4 was retail traders, which was basically, you know, your Joe Blogg sitting at home trading. And unfortunately, I have to say, CTI4 data was mostly used because retail traders, and this is why I'm saying unfortunately, retail traders have an amazing knack of buying high and selling low. So if you suddenly were on highs of the day and you saw a lot of buying activity, a lot of activity from the retail traders, chances are that was maybe getting near the high. Because unfortunately, because they're the last to know, particularly in those days and arguably still these days, retail are very good. And this was the rather unfortunate presumption that was made. Retail traders very good at buying high and selling low. And obviously we want that to be the other way around, which is why I admire you all for popping in today and having a go, you know, having a listen to me, and you know, educating yourselves as to how this market works. Don't be in that 80% of people who lose money on the markets, according to the FCA, that data. Now, moving on and talking about, let's get on with talking about market profile. I've gone off on a tangent there, sorry about that. If you've sat in on all 9 so far, you know that happens occasionally. The simplified, if you like, version of the liquidity data bank is the basic market profile, and as I've already said, that's mainly available on professional charting platforms. It doesn't actually differentiate the trader types, but it does give you a breakdown of time, price and volume, and the assumptions from market profile, as we'll see later, are based on what type of trader is active you know, at any one time. And the profile makeup and the reading of the profile is based on the statistical bell curve sort of statistics theory. Hopefully all of you have at some point come across this bell curve idea, the fact that a distribution of data will generally have a large sort of collection or distribution in the around a mean. Okay, so this is actually a chart. This is a histogram, a bell curve of heights of people, if you like, right? So a lot of people are 5'8", 5'9", 5'10", 6 foot, whereas you've got a very few number of people who are 4 foot, 5 foot and under, and then once you get above 6'5", 6'6", the distribution tails off as well. The number of instances tails right off, which gives us what's known as a nice Gaussian bell curve. Okay, a distribution around the mean that is nice and even with thin tails at either end. This is what the market profile is based on. And it's based on the notion, if you like, the initial thing that Steedlemeyer was trying to sort of put into graphical terms, was the fact that local traders, you guys sitting in the middle that are trading their own money, are more than happy if the market just stays at the same price all the time, and they can just trade away at an average price. If they can buy 2s and sell 3s all day, then they will buy 2s and sell 3s all day. But if the market moves above 3 to 4 and 5, 6, 7, 8, 9, 10, or goes back or goes lower, then actually if the markets are moving, it's because the larger the paper traders, the large banks, the institutions are doing something different to the rest of the crowd, and they're creating those tails. So basically, yeah, local traders will establish a range and happily trade within it all day. But if we move away from the mean, it's because paper is in the market entering the fray, and it's those large traders who have the legs to initiate that sort of price action and to keep things where they want them. Okay, so that's the ideology behind it. Let's now just flip over to looking at the construction of the market profile, and then we'll come back and try and sew the two things together at the end. What I'm going to do here is build a market profile chart on the left-hand side of our page, and we've got the a 30-minute candlestick chart on the right-hand side. So our 30-minute candle there shows the market opening at 24, trading up to 25, down to 19, and closing in that first half an hour of trade at 20. That's what this candlestick here is telling us. Over here we're building the market profile graphic, and we are putting the letter A next to each price the first time it trades there. Okay, so we would start off with this A here, and then, as I say, if we traded up to 25, that A would be added. If we then traded down to 23, this A here would be added, and those three A's would stay there until we either traded at 22 or 26, and we're only adding a new letter on the first instance of a new price trading over the course of that half an hour period. And those letters are called TPOs, which actually stands for time price opportunity. Don't know why it's called TPOs, time price opportunities, to be honest with you, but I will say that if you are if you do extend your reading and your research into market profile, it is an acronym laden subject, I'm afraid to say, which goes very much against my grain. I don't like acronyms that much. I never have. I prefer to try and talk in plain English, but unfortunately in this particular subject it is acronym city, so that would just have to put up with that. And there's our first acronym, TPOs, those little letters that appear the first time we trade at any price on our profile. And we've said that. Right, it's important to realize that in this basic construction that we're looking at here, it doesn't matter whether something traded once at a price or traded 20 times or 50 times. We still just put the one letter on the profile graphic. We move to the second half an hour of the day, and the candlestick tells us that we opened at 20, we traded down to 19, we traded up to 24, and we closed at 23. That's what that green candle on the 30-minute chart is telling us. And every half an hour is given a different letter in market profile. In the second half an hour of the day, we're talking about being B, and in B, every time we, so this B here next to 20 would be the first one to appear, and then we'd put a B next to each price the first time it trades. Pretty simple stuff so far. Hopefully you're following me, and we are building our profile graphic. The first hour of trading is known as the initial balance or initial balancing period, and it's just classed as the settling in period where a comfort zone range is established. There's an assumption that the initial balance period, unless you have an economic number that comes out, is very much a time where the larger paper traders do not get involved. They sit on the sidelines and wait to see how the market is developing, basically. Okay, so we've got a question. What to consider be the opening balance and opening range, and in your experience, would you allow one or both to print before entering the trade? Right, so it's the first hour of trade is the initial balance period, although if I'm trading the DAX or the FTSE futures, in fact, I use the first 2 hours, because DAX and FTSE futures open at 7 o'clock, whereas the cash index opens at 8 o'clock. So I use a 2-hour balance period for those particular markets. And FX, it gets a little bit more difficult, but we'll discuss that a little bit later as well. So the initial balance period is represented on my profile charts that we're going to be looking at today by a line on the left-hand side of the profile. We move to our third half an hour of the day, and our candlestick chart shows a doji-shaped candle. We opened at 23. We went down to 21, up to 26, and closed back at 23, according to that candlestick. what we're doing on the profile is adding the letter C. So this one would appear first, the one at 23. That's the first price. We know that from the candle chart. So that would appear first, and then we would add letter C's to the chart, to the profile graphic each time we print one of those prices for the first time. Now, what you'll notice on what I'm constructing here is that we are actually pushing these letters as far to the left hand margin of the profile as possible. So because this 26 price, the C period, is the first time it's traded over the course of this day, that letter C is on that left hand margin. It's on that left hand side of the graphic. We move to our fourth half an hour session of the day, and we opened at 23. We went down to 16 and we closed at 21, and we're adding the letter D and we're pushing it as far to the left as we can in order to, and you can now see, hopefully, and let's move to the fifth half an hour. There we go. Opened 21, closed at 19. That was the range. Letter E, putting the letters E on each of those prices when they first print. And we can see, hopefully, we are starting to build a bell curve, but it is on its side, whereas our distributions bell curve was was like this. We've actually just rotated that 90 degrees here with price, and price is the vertical axis, and arguably time is the horizontal. At that point, we have got to the point where we have a horizontal line of TPOs, and the longest line of TPOs that's closest to the center of the day's range represents the price at which most trade has taken place, or the fair price, or the average price, if you like, the mean price. And based on bell curve theory, that could and should act as a magnet for price, and is known as the TPO point of control. And the point of control on that particular on our chart is 21. It's traded there every single period over our 5 half an hour periods. It's the longest line of TPOs, and it is also, in this case, just to keep things simple while we're doing the theory, it is the middle of the day's range as well. Now, Steidlmayer wasn't happy with having one price that was value. He used statistical analysis again and said, I'd like to know where is the zone of value that is one standard deviation either side of that point of control. And if you know statistical theory, a standard deviation equates to around 70% of a data set. So what Steidlmayer did was said, where's the middle of, where's our point of control? We know that that is right here at 21. We are now going to move away from 21, higher and lower, until we've got 70% of the market counted, if you like. And in this case, again, I've just tried to keep things as simple as possible just to explain this to you. We move up 1, 2, 3, 4, 1, 2, 3, 4. 1, 2, 3, 4, 1, 2, 3, 4. So we're just starting in the middle and counting out until we've got 70% of the TPOs, and that creates the value area, as is known in market profile parlance. Okay, and so this is the area where 40% of the 70% of the volume goes through, 19 to 23. And the value area is represented by, on my charts, by a blue line on the right hand side of the profile. So this is what a market profile graphic looks like, and the bit I've explained to you already is this bit here with the letters. Okay, but we've actually got two graphics here, and on the right hand side next to it is the same data, but this is just expressed as volume at price. Okay, so we're not concerned by time so much, we're just concerned by actual volume at each price if we're on this right hand graphic here. Now that is, for me, the most important the most important mark, if you like. Back in Steele and Myers days, when this was first dreamt up, if you like, we didn't have reliable volume data on futures markets, because it took sometimes till the end of the day for the exchanges to collate all the data properly, because it was all manually inputted. What you could get in those days was what's traded each half an hour at what price. Now, because everything's done in real time, we are able to know that at least on futures markets, that this is accurate volume data, and it's accurate up to the second. Okay, so the volume profiles have become more of a thing, and so that's what I would concentrate more on, and I calculate my value areas around the volume point of control, as opposed to around the TPO point of control. I hope everyone's following me. It does get a little bit wordy and a bit mucky. Now, there's a couple of other bits of information that are actually shown on here as well. There's a mid-range marker there. There's opening prices. Is a small arrow there, and the closing price of the last trade flicks up and down as a little arrow either on the end of on the right hand side, hugging the profile there. If you use the premium product on TradingView, this is what the profile graphics look like, and actually has an additional piece of information, which is the point of control, the value area high and the value area low, on a kind of as we go through the day basis, which is quite a nice thing. But you can see how those value areas actually developed over the course of the day. The rather strange color scheme going on here is that this area is the value area, and the slightly less shaded distributions of volume are this is below the value area and above the value area here. Above the value area here, this is the value area. There's very little below the value area on that particular one. Okay, so that's how it looks on TradingView if you go for the premium subscription on that. So, having gone through all of that and having an understanding of how it's constructed, next question is, what does it do for us? And quite simply, what it does is provides an evolving picture of how a day is developing. It's not actually designed to give buy and sell signals in the same way that there may be a stochastic crossover is, or Bollinger Bands can be, that kind of thing. We're not actually talking about something here that says buy it here, sell it here. It's trying to give you an idea of how the market is developing over the course of a day, and who's running the market on that day, if you like. It can provide you with support and resistance levels, because it actually tells you how much time was spent at each price, and so by doing that, it can say that this is an area of low volume, so it could again be a pivotal area when we go forward, or it's an area of high volume participation, which again price can be attracted to, or if there's lots of trades that have gone through at a particular price, then the market has a memory and people have positions based around that price more than any other price, so it can, again, those prices can be an important proxy. The other thing it tries to do, and this is where I think it has real use to us, is providing a perception of an idea of the market's perception of value. Where is value, and are we close to it or moving away from it, is basically what it tries to offer us. And so it tries to identify which groups controlling the market between our short-term speculators, the locals, the algorithmic trading models, if you like, as it is now, or the longer-term players, the paper, the institutions. Who is in charge? Because you can make a basic assumption here that basically markets that stay near to value are controlled by the short-term time frame traders, and the longer-term traders are sitting on the sidelines. They're happy with where the market currently is, and they don't feel the need to enter the market to move it higher or lower. They think it's okay where it is. Whereas if they do move into the market and we start to move away from value, then that is those larger traders trying to assert their thinking on the market by trading it. I think it's too high, therefore I'm going to sell it. My selling, because I am big, will push the market lower, if you like. There's the assumptions. And so here we have three profiles that are basically just building sideways, okay, and they're building outwards, if you like. Whereas here and here and here and here we have profiles that are building downwards vertically, if you like, and then we get to here and then the profiles start to build sideways again. So we've got three very distinct market conditions there, where the market's happy where it is, happy where it is, happy where it is, and then there's a realignment of the thinking of value, and then we get to a price where the market finds balance again and we start to balance and go sideways again. And there is a school of thought, and it's something that a lot of professional traders that I've sat with and worked with over the years subscribe to, that the market is trendless 70% of the time. And so actually, that can be a difficult thing to really get your head around. But once you do get your head around that, it can be very useful, because you can basically say 70%. If I'm looking for big moves in the market, then 70% of the time I'm not going to get it. I'm looking for, and if I'm trying to trade big moves, then I'm only going to get that 30% of the time, and I have to accept the fact that for 70% of the time the market is trendless, and therefore if I'm trading moves, then I've got to be, I probably have to spend 70% of my time just watching the markets, not getting involved, and not over trading in choppy, trendless markets. Or there's the flip side of that, which is traders who say, I like choppy, trendless markets because I can safely buy low and sell high within a tight range, and I'm okay with that. I don't want the glory. I don't want to be strapping on trades for 500 ticks. I don't care. I'll take 5 or 10 ticks out of something 10 times over the course of the day, and I'm more than happy to do that. And so you professional traders who sit in front of the machine all day and trade futures, the guys who are, my main client base, have been for a long time, they're very distinctive and general about what type of trader they are out of those two groups. And they're trying to identify which market conditions we're in and trade the market conditions that suits them. I know traders who don't trade on the first Friday of every month. They hate non-farm payroll because the markets just move without rhyme nor reason, and they're too volatile, and there's no particular order to things, and they don't want to trade those kind of markets. They're more than happy to trade the morning of payrolls when there's not a lot going on, and they can just try and take money off of the table quietly in fairly listless markets. So yeah, that's an important thing in itself, I think, that's worth considering for anyone who's starting out in trading, which is you need to know what type of trader you are. Daniel's asking which type of trader is more profitable. I think actually the most profitable traders I've ever come across are the guys who can do both. And I think, again, market conditions are very much dependent on the answer to that question as well. It's a bit of a sort of how long is a piece of string question. And because what we've seen in the last year or so, I mean, equity markets, for example, we've seen a real contraction in volatility. And so if you are a position trader and day trader, then it's probably been increasingly difficult to make money, whereas unless you lengthen your time frame and you just sat on a long for the last year basically, and then you'd probably be okay. Daniel, there isn't really an answer to that question. Sorry to be sorry to not be able to answer that for you, but I think that the key takeaway, I would say, is try and work out what you are and do what suits you and your personality. So what have we got? What are we saying here? Because I went off thing there a bit, didn't I? In constructing the day's value areas, profile attempts to give us an idea of whether the market is trading at fair or unfair value, i.e., where are we now compared to yesterday's value area? Are we within it, which means that the market is still quite happy where it is, or are we moving away from it, in which case something may be happening from the paper guys? Are we trading vertically? And as I've illustrated already in that previous slide, and as I've mooted too, markets tend to flip between periods of balance and imbalance, and the types of profile being posted can indicate which conditions are prevailing at that time. We can build composite profiles to pull together a number of sessions, and we'll look at that a little bit later. Imbalanced prices can often gravitate towards previously accepted areas of balance. That's an interesting thing. If you've done any reading up on profile, you have probably had a go at reading this book called Mind Over Markets by James Dalton, Eric Jones, and Robert Dalton. And I don't know if you have read this book. I've tried to read it. I have read it. I've read it a number of times, over and over again, in fact. But I've always found it to be a rather difficult book, if I'm honest with you. One of the chapters in this book talks about types of day. Okay. I'll be, I shouldn't. It sounds like I'm slagging this book off because, and maybe I am a bit, but there's also, I do know a lot of traders who absolutely swear by this book. They think it's the absolute bee's knees, the best book ever, and da 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 da. So it's one of those. It's each to their own. I'm not a massive fan, if I'm honest. And there's different types of day, and they've got some wonderful names. We've got a normal day, a normal variation of a normal day, a trend day, a double distribution trend day, a non-trend day, and a neutral day. They're the basic day types. This one here, a normal day, and this one here, a non-trend day, and a neutral day, are very much the market's just going sideways, whereas the two in the middle, the trend day and the double distribution trend day, which I find to be the ones I like the most, if you like, the ones you can get the most information for going forwards. They are days where the market has moved vertically. Okay, they're all different scales on these charts, but so it's difficult to actually compare them. Maybe I should do that differently. But trend days and double distribution trend days are the ones I like. Will, I'll answer your question about composite later. We'll have a look at that, don't worry. Lots of leading chart. In fact, we're getting onto that now. By the look of things, we're going to look at bell curve or composite profile charts because it can give you extra clues as to the market's bigger picture perception of value, and can show up longer term support and resistance levels that might have an effect on things going forward. And with the increasing computing powers we've had in recent years and increasing availability of data to a wider audience, there's much more of this going on now, looking at historic volume of price data, and auction market theory has become a bit of a new strand of analysis. This is what I had to look at 10 years ago. It was just the TPOs, and you could bundle a bunch of them together. I've got 2 weeks worth of daily TPO or 30-minute TPOs all bundled in there together, and that shows you that we've got high, lots of volume going through at this price, very little, well, just one half an hour period's worth of trade going through at this price, and then we're building another volume, what's known as a volume node here, and then we break lower here, and we've got steadily lower prices after that. This is what a little bit more how it looks for us on our charting systems these days. And what we have here is a period of balance, if you like, here over the course of maybe getting on for 2 weeks, I think, where the market builds a high volume node here in the middle of all that price action. That's known as a composite high volume node, CHVN. It's similar to a point of control, but we are applying it to a longer period of data, if you like, right? And these are periods, these are prices at which hardly any volume went through, and they're known as low volume nodes, composite low volume nodes. And so we can see that here, from here to here, from this period all around here, we build this fairly classic Gaussian bell curve shape with a nice big distribution near the middle and then thin tails. But then here, after we break lower here, and during this period of chopping lower and or trading lower highs and lower lows, you can see that there is lots of smaller high volume nodes and lots of low volume nodes. Okay, now what we're saying here is that balance will build you a nice pretty Gaussian bell curve shape, whereas imbalance will have messy composites basically, and we'll show the composite will show up as looking rather messy with no clear perception of value. The market is looking for value. It's looking for balance during this time. It had it here, then it broke it, and we moved to a phase of looking for balance. And this bunch of this composite area down here is saying we are not finding any clear balance. I use 20 days as a default setting for my composite profiles. Okay, well, that's my default. It's about a month's worth of data basically. Some people try to take it to another level of bracketing certain periods of time to say, look, there's a period of balance, we're just going to put that into one composite and then we're going to build a new composite for this period here. You can do that, and it's something worth looking at, but one of the things I like to do is to a little bit like you try and find a moving average that works for you and stick to the one period setting. I've found that using 20 days worth or a month's worth of data on a rolling basis has merit basically, and that's what I like to do. It's personal preference. And that's what a longer term or composite profile looks like on Trading View. We have again the value area in a different color to what's above and below basically, but we've built this composite chart off to the right hand side of the candlestick chart. And again, what it does quite nicely on Trading View on the premium product is give you a sort of a running a historical running look back at where the value area highs and lows and the point of control were historically. So that's quite a nice thing, I think. So yeah, the longer term composite profiles are basically sort of trying to identify where we are in this cycle of this constant cycle of the market moving from balance to breaking balance, to trending and searching for balance, to finding that balance, and then going back to balanced conditions. So it is almost like a merry-go-round of, okay, the market's balanced at the moment. Okay, we've broken the balance. When we break the balance, that balance, you will see single print vacuums, and you will see low volume nodes, and you see sharp breaks of support and or resistance. Support if we're going down, resistance if we're going up. And then we will be looking to, we'll be trending phase, and your profiles will be building vertically, and you'll be getting range extensions in one direction, and your volume nodes will be doing a job as support or resistance, and you'll be seeing steadily lower points of control. Then when you start to see large single print tails rejecting highs after an uptrend or rejecting lows after a down move, and your profiles start to build sideways again, then okay, we're finding balance again, and then you get back to bracketed or balanced markets. So it's this kind of constant merry-go-round of these conditions, if you like, that we're watching in the markets day by day. Okay, and here we have, value areas that are overlapping each other, points of control that are at similar levels. Markets balance during this period, and then we break. We see single prints within the profiles, the daily profiles there, and then we find some balance back where we found balance, right back here. That's the kind of thing we're talking about. What I like to try and do is combine market profile and the composite, what's on the composite charts, with more traditional ways of looking at the markets. And obviously, as we may have previously mooted, candlesticks is one of my favourite things, vary in different time frames. And then throw the put the Fibonacci overlays, trend lines, chart patterns. And when you get things that are coinciding with each other, and you have a high volume node that coincides with a Marubozu line and a trend support line, then suddenly tick tick tick, you're getting lots of reasons to say that's an important level and something I want to be keeping an eye on. So to do a bit of acronym busting, if you like, we have high volume nodes. If they're on the composite chart, you have composite high volume nodes, CHVN, and then you have low volume nodes, CLVN, the value area low and high, VAL and VAH, and then you have the point of control, POC. VPOC is a volume point of control, and sometimes you'll see people talking about SPVs, single print vacuums. I did warn you there would be lots of acronyms, and I did say I don't like it, and I don't like it. So yes, it doesn't provide you with out-and-out signals. It builds a picture of how the day is developing and give you clues as to how you may treat the rest of the day. Is it a trending day or a trendless day? How am I going to trade it on that basis? You do need a first hour or two to be out of the way before you really know that for sure. Also, traders look at the relationship between yesterday's value area and where we're opening on the new day. Are we opening above value or below value? Where is the value area, high or low on that basis? That's that could be one of the first levels to watch out for. I've sat with thousands of traders that trade profile, and I don't think any one of them has ever given me the same sort of methodology as the next one. People use it in very different ways, so it is not something that is that can be. I've done my best here to try and sort of go through the theory of it, but I can tell you that there's lots and lots of different ways of looking at this, and I can tell you that from my own experience, because I've spent the last 4 years scratching my head about writing a book on market profile. I've always wanted to call it Market Profile Made Simple, and I think I've realized now that there's just that's almost an oxymoron of a title, because it's just not a simple thing that you can that you can express to people in simple terms, especially considering the diversity of methodologies that I've seen people use, how they use this. Pitfalls and pratfalls. FX markets have no proper volume data, so obviously we're relying on tick volume, which means that you can, if you're using the overnight profiles as well, and let's say you're looking at Euro US dollar and you're looking at a 24-hour profile, Euro US dollar can quite often spend most of the Asian trading session going nowhere, going sideways. That will build very quickly a large point of control that maybe isn't a true reflection of value for that day, because actually it was just for the bit before the market really woke up and got going. That's something to be aware of. Futures markets can be a problem when it comes to rollovers, because rollover volumes can distort the true picture of where volume has gone through. And I've already discussed this idea of using fixed time periods for composite profiles, which is what I do favour, but like moving averages, what's dropping off the back end can have an effect on the ongoing message that they're giving to you, and that's something that happened 21 days ago. So is it really relevant to what's going on right now? That can be a bit of a pratfall as well. So some people prefer to bracket their composites and take in and try and identify when are the phases where when we're trending and when are we trend less, and let's try and split the profiles based on that. Remember, US futures traders swear by this. if you're looking at the S&P or T-notes or anything that trades out of the US, then I'd say it's worthwhile knowing where the profile levels are, which is why I put them on my reports every day, because my traders, my client base, want to know this information. And like anything in technical analysis, the best way to use it is in conjunction with something else. Don't forget that the basic tenet is that it's long-term paper traders that are moving the markets. And you know, and if you want to know more about this, there's plenty of resources out there, and also a good, you know, a small plug for my own product here. I do talk about profile on a daily basis on a lot of them reports that I send out. So, you know, if you haven't had a trial already, please give me a shout and ask for a free trial. There's some online resources there, but I would warn you about one thing. On the CME website, there is a market profile handbook, but that in itself is another oxymoron, I'm afraid, because it's not really a handbook. It's 346 pages long. Not really a handbook. Chris, we're getting quite near the end of the of our allotted time period, aren't we? And hopefully,
We certainly are.
We've answered questions as we've gone along. And in the spirit of next week being a bit of a Q&A and a look at current markets, unless anyone's got anything urgent, shall we call it a day and reconvene next week?
Yeah, absolutely, Clive. Did you see Will's last question about the overnight profile?
I think I kind of just answered that with respect to, you know,
Right,
can
okay.
cause a problem.
Yeah.
Can cause a problem in building points of control that aren't a true reflection. They're just where we were stuck at for most of the overnight session.
I suppose it's like all
charts.
charts that are
Got it.
overnight
So
have a
there you
lot
go.
of noise.
Will's a happy man, and so hopefully everybody's got something out of today. So please
Fantastic.
come back next week, and please come back with a lot of questions. That's what I would really encourage everybody to do. Some advance warning on anything you might be interested in looking at would be useful. So Chris, if you want to just shout your contact details one more time so people can get in touch with you.
Absolutely. We're at office@dfmarkets.co.uk, or come onto the website and come on the live chat function there. And what I might do, Clive, I might send an email out to all the attendees for the webinars to sort of prompt questions via email.
Excellent. Okay, nice one. Thanks very much for listening, everyone.
Thanks, Clive. I'll see you next week.
Cheers, Chris. Take care. Bye-bye.
Cheers. Bye-bye.